from this problem. This problem was asked in June 2009 and the topic is corporate objectives. So let's start with the concept here. So required is evaluate the financial performance of JJG Co. and analyze and discuss the extent to which the company has achieved its stated corporate objectives. Okay, so we have to analyze and discuss whether the company has achieved its objectives or not. Number one, the objectives of maximizing the wealth of its shareholders and achieving continuous growth in earnings per share. Okay, so how do we measure the shareholders value? So we have a list of formulas also, but we will first read the question and then we'll use the formula as appropriate. Okay, so the company is planning to raise 15 million of new finance for a major expansion of existing business and is considering a rights issue, placing or an issue of bonds. The corporate objectives of the company, as stated in its annual report, are to maximize the wealth of its shareholders and to achieve continuous growth in earnings per share. The recent financial information of the company is as follows. Okay, so from 2005 to 2008 data they have given. So they have given the revenue, PBIT, earnings, dividends, ordinary shares, reserves, bonds which are renewable bonds, and share price. Okay, they have given all these things, and the nominal value of the shares of the company is $1 per share. Okay, that's the nominal value of the share. So the general level of inflation has been 4% per year in the period under consideration. The bonds of the company are currently trading at their nominal value of 100. The following values for the business sector of JCO are as follows. Okay, so they have given us see, these are the other businesses or the industry average or the sector average here. So other companies are having an average ROCE of 25%, average shareholder fund of 20%, average debt to equity of 50%, and return predicted by the CAPM model is 14%. Okay, so we have to tell have the company achieved its objectives. Okay, but whether it's going to be for 1 year or how many years, it's not given, and the maximum mark is only 6 marks they have given for financial analysis. Okay, so how do we find out what are the various formulas we have to work out? Number one, if they have given some kind of a set of ratios, then we have to compare and analyze that ratio. Okay, we have to compare and analyze that ratio. So we have to work out all these 4 ratios. Okay, plus we have to find out how to find out the maximizing shareholder return. So that also we have to find, as well as EPS. Okay, so that also we have to find. So that's why if you see 4 plus 1 plus 1, that gives us 6 ratios. So for 6 ratios we have to find out how they have moved. Okay, so we'll take first the ratios that we require. So we need ROCE. ROCE is the first set of ratio. The second set of ratio is return on shareholders fund, so that is also available there. Debt to equity is also required. So we have debt to equity. Then we have CAPM model. So we have the CAPM model here. Okay, so we got the 4 ratios. Thereafter we need to analyze the shareholder wealth, maximizing shareholder wealth. So we have that formula. We'll use this formula, total shareholder return formula we'll use, and thereafter we have to find out EPS. Okay, so EPS we have to find out. So we'll start with the working note. So we will work out only these 6 ratios. Okay, and we'll write a comment about how these ratios have moved. Okay, so we'll start from ROC. So ROC ratio is, see, somewhere the general level of inflation is 4%, right? So we have to adjust that to but we'll if possible we'll just ignore inflation and we'll work it out so that it would be better. Okay, so we'll ignore the inflation and then we'll work it out, or else it will take a very long time. So we'll start from the ROCE. So ROCE is like quite easy. This is the formula for ROCE. So we need the capital employed. So for finding out the capital employed, we need total assets. Is total assets available there? The answer is no. So you can't use this formula. We'll remove it. Capital employed can also be found out through equity capital preference plus long-term debt. So equity capital, see the number of ordinary shares value is given, okay, and the share price is also given, okay. So we can use that as a metric. So we'll use that. Okay, so we'll have the years here. So capital employed first we'll try to find out. So what is the capital employed here? So capital employed is going to be the equity of 5.5 plus preference share is not there. Long-term debt we'll try to find out. Long-term debt is the bond, so that is going to be $20 million. So capital employed is 5.5 plus 20, okay, and that is the same for all the years. And operating profit, if you see, operating profit is the PBIT, so all that numbers we have to separately type. So it's 9.8, 9.8, 8.5, 8.5, 7.5 and 6.8. Okay, we are not adjusting the inflation, we are just working out as it is. So we can get the ROCE now. So ROCE would be operating profit divided by the capital employed into 100. Okay, so this is a percentage number. So we got the ROCE. So we'll just take this number and we'll put it here. Okay, so ROCE is a percentage number. So ROCE we have worked out. We will again work out ROSF. So we'll work out that. So ROSF is net profit divided by the equity shares, reserves and preference shares. Okay, so here it's going to be, we have to find out again two more things here. So we need two more things. One is net profit. We need to find out the net profit. We also need to find out So we have the net profit here, earnings. Okay, so earnings is also called as net profit. That's going to be 5.5, 4.7, 4.1, and for 2005 it is 3.6. Okay, so next we'll find out the equity, reserves, and preference share. So see, they're asking only for shareholders fund. So these are the only shareholders. So equity, if you take, it is only 5 point, I think it was around here. Okay, 5.5 million. Okay, see, there is also a reserve. There's also a reserve part. So reserve part also we have to add. So if we add the reserve, so shareholders fund is equity plus reserve. So we'll get the reserve part. Reserve part, if you see, it is 13.7, 10.4, 7.6, and 5.1. Okay, you can add both the equity as well as the reserve. Shareholder funds would be the net profit divided by the shareholders fund into 100. So we'll move on to the debt equity ratio. So for debt equity ratio, we need the bonds. Okay, so it's going to be long-term bonds divided by equity shareholders funds. So first we'll get the long-term bonds. So long-term bonds is here. Okay, so it is 20 million. And equity shareholders funds, okay, as there's no preference share or anything, we can just copy the shareholders funds here. From there we can get it, and we can put the number here. So we'll now work out the debt equity ratio. So the debt equity ratio would be long-term debt divided by equity shareholders funds. Okay, so we have done that also. So next we'll find out the next one is CAPM return model. So to find out CAPM model, we need certain numbers. Okay, only then we can find out the CAPM model. So let's start. So we need numbers like this is a formula. Formula is risk-free rate of return plus beta into RM minus RF. Okay, so we have to get these numbers here. So risk-free rate of return we have to get. Only if it is available we can do it, or else it's like impossible to do it. So risk-free rate of return, I don't think it is available. Okay, I'm not sure how to work out this formula because there is not sufficient information to do that. So we'll move on to the next one. The next one being total shareholders return. We'll work out that formula at least. So to work out the formula, we need data such as dividend and share price. We need both. So dividends, if you see, the whole dividend is paid. Okay, the whole dividend they have shown here. We need it in terms of the number of shares. Okay, we can't work out the number in terms of like the total dividend. We have to get DPS. So I think first we have to get DPS, then only we can proceed. So to get that, so first we'll get dividend amount, then we'll divide it by the number of shares. So finally we will get our DPS. So that's the first step. First we'll do that. So dividend number is, I think we'll type, dividend number is 2.2. 2.2 million, 1.9 and 1.6 and 1.6. Okay, so then we have to get the number of shares. So number of shares is 5.5 million. Okay, each share has a value of only 1, so we can take it as 5.5 million shares. See, this is also in million. This is also $1 million. This is also in $1 million. So they will get cancelled properly. So this is also in million, dollar million. This is also in dollar million. So this is in million. Okay, so let's get the answer. What is the dividend per share? The total dividends divided by the number of shares. So 0.4, like that. Okay, so we got this. We also have to get the amount, the share price we have to get. So share price, if you take, the share price, it's going to be 8.64, 5.74, 3.35, 2.67. Okay, so in terms of share price, okay, the ending share price are these numbers. These are the ending share price. But what about the beginning share price in that period? See, the beginning share price are these numbers, right? These are the beginning share numbers. So the share price in 2008 beginning was 5.74. At the end it was 8.64. And in between they have also got a dividend, right? They have also got a dividend. So dividend is 0.4. Okay, so what is the total shareholder return? So the total shareholder return would be the share price at the end minus share price at the beginning plus the dividend, okay, divided by the share price at the beginning, all of this into 100. So we can only work out for 3 years. Okay, we can't work out for more than that. So this TSR is a percentage number. It is a percentage number. So if you want, we'll put it here. So let's copy it and we'll put it in the table above. We have not done CAPM. Debit equity we have worked out, so we'll copy that. So the last one is EPS. So let's get the EPS here. So to work out EPS, we need two numbers here. So we need net profit and we need number of shares. Okay, so first we'll get the net profit. So we have already got the net profit for this calculation, so we'll copy that number. And for number of equity shares, in the last ratio only we have computed number of equity shares, so we'll take that. So now we can find out the EPS. So we'll get the EPS now. Net profit divided by the number of shares will give you EPS. So we have got our EPS also. So we'll copy this number. So we have got almost all numbers. So what we'll do is we'll now go for a discussion. So discussion is, has the company performed really well or not? Okay, so look at here. From 2005 to 2008, the company has increased its ROC. Okay, so we can put that the company has increased the ROCE. Okay, over the years 2008 to 2005 to 8 period. Okay, so that's about ROC. Let's look at ROSF. Okay, return on shareholder fund. So return on shareholder fund seems to be a little bit going down, thereafter down, and still it is way down. Okay, so why is return on shareholders fund is actually going down? See, that seems to be a different kind of a picture here. So if you see, the net profit seems to be rising. The net profit seems to be rising. Equity shares are also rising. It's only because of the reserves. Okay, the shareholder funds is like increasing. So we can say that the company has increased the reserves and that has caused the return on shareholders fund to go down or to decrease. Okay, decrease over the years, over these 2 years. Okay, so that's not a bad thing at all. Okay, it's just that the reserve is like becoming bigger and bigger. That's why the ratio has gone down. So it's not a bad thing. In terms of debt equity, the company has improved. Okay, from 1.8 they have reduced it to a much more manageable level. So we can put it like this: the company has decreased the debt equity ratio over the years, and that is good. Okay, so Increasing the ROCE over the period is good, and the shareholders fund is decreasing. See, that is also good only. That's not such anything bad or anything. Total shareholders return, if you see, they have increased it. Okay, over in 2007 it went a lot, but again in 2008 it has come to a lower level. Okay, not much lower level, but what has happened here is, if you look, their dividend seems to be like very strong and it is growing. Dividend is growing, but share price, if you see, okay, share price has moved a lot higher. Okay, share price has moved a lot higher, so that's why you see the variability in the TSR ratio. So the variability in TSR is due to uh, high fluctuation in the share price. Okay, but overall the company has increasing its dividend and share price. And the last one is EPS. So the company seems to be increasing its EPS really well. Okay, so the company has increased the EPS over the year 2005 and 8, and that is good. Okay, so overall it seems to be the company has been doing really well. Okay, whether it's in terms of EPS, DPS, or ROC, RSF, or debt equity ratio, or TSR, the company seems to be doing really well. So that's what our overall discussion is all about. Okay, so hope you guys got a good idea of how to measure the financial objectives of a company. Okay, so this is how it is being done. So in reality also, this is how it is usually being done. So thank you very much for watching this part of the session. We'll move on to the next session.